Welcome to the Chapter 5 tutorial on merchandising operations. In this tutorial, we're going to focus on merchandise sales. So think about companies such as Superstore, Walmart, 7-Eleven, Costco. They all buy inventory and then they resell that inventory to their customers. We're going to look at this new term called gross profit or gross margin. Gross profit or gross margin is essentially sales revenue minus cost of goods sold. So think about it this way. Let's say that you go to Safeway and you buy some groceries. And so for Safeway, let's say the sales revenue for what you buy is $50. So that's what you pay Safeway for all your groceries. Now, obviously, they had to buy those inventory items before they sell it to you. And so the cost of those inventory items is known as their cost of goods sold. And so let's say they purchased all those inventory items for $35. Their gross margin or their gross profit is going to be $15. So gross profit or gross margin is going to be used interchangeably. Some textbooks use the term gross profit, others use the term gross margin, but they mean the same thing. Now, this cost of goods sold is going to be a new expense item on our income statement. So that's a little bit about how merchandising operations differ from service-oriented operations. They buy inventory, and then when they resell that inventory, they expense that amount as cost of goods sold. Now, in the textbook, they talk about two types of inventory systems, perpetual and periodic. Now, our focus is going to be on the perpetual inventory system. The perpetual inventory system always has an up-to-date inventory account, and every time there is a sale, the cost of goods sold is also updated. So when we think about a perpetual inventory system, think about stores such as, Safeway, Costco. Whenever you go to those big grocery stores and you look at your receipt, it actually tells you exactly what you bought. 4 liters of milk, 2 cans of corn. And so with a perpetual accounting system, the inventory is always up to date. Every time they make a sale, the inventory gets reduced. Every time they make a sale, their cost of goods sold is also recorded. So that's an example of a perpetual inventory system. A periodic system, think about that as your small corner store. In your neighborhood, there might be a corner store. Whenever you go and buy something, the receipt does not give you a breakdown of exactly what you bought. It might just say item 1, item 2, item 3. That cash register is not connected to their accounting system, so their inventory is not going to be up to date, and their cost of goods sold is not going to be recorded at that point in time. So once again, our focus for this course will be on a perpetual inventory system. Now, when it comes to the purchase of inventory, when does ownership of the inventory transfer? If you think about a situation where, let's say a company is based in, let's say, Vancouver, British Columbia, and they buy inventory from a supplier in Calgary, Alberta, when that inventory is shipped from Calgary to Vancouver, when does ownership transfer? And that's when we get to these terms, freight on board shipping point, and also freight on board destination. This determines when the inventory ownership transfers and also indicates who pays for the freight cost. When you see the term FOB or freight on board shipping point, the goods transfer ownership the moment they leave the seller's premise. So the buyer takes ownership the moment they leave the seller's premise, and so therefore the buyer is responsible for the freight cost. Now, conversely, FOB destination, freight on board or free on board to the destination, that means the goods transfer ownership when they are delivered to the buyer. So that means the seller maintains ownership when they're being delivered to the buyer, and only when they get to the buyer's destination will the transfer of ownership take place. And so the seller has to pay the freight cost. Now, if we go back up to FOB shipping point, if the buyer pays the freight cost, they would add that to the cost of the inventory. FOB destination, when the seller pays for the freight cost, they would just record that as a selling expense. So there's a difference in how the freight costs are treated, depending on whether it's paid for by the buyer or the seller. Now, before we get into some journal entries, I want to just talk about this cost of goods sold equation. Now, this cost of goods sold equation basically says that at some point, at the beginning of the year, the company is going to have some amount of beginning inventory. All the purchases they make during the year, if we add that to the beginning inventory, that's going to give us our goods available for sale. So beginning inventory plus all the inventory that is purchased, that's going to equal goods available for sale. That's going to be the maximum amount that the company can sell. Now, the goods available for sale will either be sold and become cost of goods sold, or they're going to remain unsold and become ending inventory. Let me give you an example on the side here. Let's say we have this company and their beginning inventory, let's say, is $100,000. And let's say during the year, they make all these purchases. We're going to call it net purchases. Net purchases is basically all your purchases minus any returns and allowances. And so let's say our net purchases equal $250,000. If we add those two together, our goods available for sale is going to be $350,000. That's basically the maximum amount that we can sell during the year. We had $100,000 at the start. We bought $250,000. So the maximum that we can sell, the goods available for sale, are going to be $350,000. Now, those goods available for sale will either be sold or they're going to remain unsold. Now, the amount that is unsold, that's going to be our ending inventory. And so let's say that this company has a periodic system. Periodic system, think about that small corner store. They do not update their inventory or cost of goods sold with every sale. They know that their beginning inventory is $100,000. They track all their purchases as $250,000, and so they know that the maximum amount they have available for sale is $350,000. And let's say at the end of the year, they do an inventory count, and their ending inventory count shows that they still have $75,000 of ending inventory at the end of the year. So therefore, based on this cost of goods sold equation, we can now figure out what is our cost of goods sold. If we have $350,000 available for sale and we still have $75,000 at the end of the year, that means we must have sold $275,000. That's the $350,000 minus the $75,000. So that's the cost of goods sold equation. What I want to do next then is go to a couple of questions in your textbook. So grab your textbook, turn to page 289, and have a read through 5-21 and 5-22 and see if you can figure out what is the missing cost of goods sold amount based on the cost of goods sold equation. So pause the video here, and then once you're ready to check your answer, then resume the video. Okay, let's take a look at starter 5-21. Now we know that for these two questions, we're looking at the cost of goods sold equation. So in 5-21, we're told that the beginning inventory is $16,000. So this company started off with $16,000 of beginning inventory. And then we said we're going to add our net purchases. Now, net purchases is basically all of our purchases. And if we look at the question, we had purchases of $180,000. Now, we have to subtract any returns and allowances. And we know that we returned $12,000 of inventory, so we have to reduce that. And also, as we said earlier, if we have a situation of FOB shipping point and we, the buyer, are responsible for the freight costs, then we have to include that in the cost of our inventory. So that $1,500 in freight cost, we're going to add that to our purchases, our cost of our inventory. Therefore, our net purchases is going to be 169,500. And then we add those two together, and that gives us our goods available for sale. And so our goods available for sale are going to be 185,500. Now, we're also told that at the end of the year, the company had ending inventory of 32,000. And therefore, based on our cost of goods sold equation, our cost of goods sold is going to be 153,500. So that's the missing amount for starter 5-21. Now let's then go over and look at starter 5-22. Once again, fairly straightforward. We should be able to do this quite easily now. Beginning inventory of 24,000 plus our net purchases. And once again, our net purchases is going to be all of our purchases minus any returns and allowances, add on any freight costs. And once again, we have 272,000 minus 18,000. So our net purchases is going to be 254,000. We add those together, our goods available for sale equals 278,000. And once again, that's either going to be sold, cost of goods sold, or unsold, ending inventory. Now, in this example, we know our ending inventory. So what we can actually do is just subtract our ending inventory of 34,000. And that's going to leave us our cost of goods sold of 244,000. So that's the answer to starter 5-22. This again is the cost of goods sold equation, and this is what periodic inventory accounting systems use to figure out what their cost of goods sold is for the particular year. Now let's go back to our handout and let's look at page 2. So on page 2 of our handout, we're going to talk about what goes into inventory costs. Now we said earlier that if a company pays for their freight, then they have to include that in their inventory costs. Now the rule is that all costs necessary to bring an item to a saleable condition and its location must be added to the cost of the inventory. So things such as freight, insurance, those would be all added to the cost of inventory. Now, when we calculate and record purchases of inventory, we always debit the inventory account whenever we buy inventory. Now, if we have any discounts, returns, and allowances, that's going to decrease the cost of the inventory. So then we'll credit the inventory account. And once again, if we have things such as freight, insurance, etc., installation costs, things to actually improve the value of the inventory, those will all be a debit to inventory. That would increase the cost of the inventory. So then let's look at starter 5-3 and 5-4. So take a minute, turn to page 286 in your textbook, read the questions, and then we'll work through those together. So pause the video now to read those questions. Okay, let's have a look at starter 5-3. Now in starter 5-3, we're asked to figure out what is the cost of the inventory to Marks. So Marks uses a perpetual inventory system. All I'm going to do is just draw a T account. So if we just draw an inventory T account, this will tell us what would be the value of the inventory. Now we know that the cost of the t-shirts, the 15,000, we're going to add that to the value of the inventory. Now Marks also has to pay for the shipping or freight costs, which is $1,000. That's going to be added to the cost of the inventory. Now in your textbook on page 245, it says all the costs to bring the inventory to the point of sale is added to the cost of the inventory. So therefore the duty and excise fees, that $200, that's going to be added to the cost of the inventory as well. Now when we get to the fine, for unloading the inventory in an unauthorized area, that's going to be an expense. The fine was actually not required. That was basically a mistake that the company made. They should not have been there. So that was not a required amount to bring the inventory to the point of sale. So the fines would be an expense amount. And so in the inventory cost, we would just have these three amounts. So the total cost of the inventory would be $16,200. Now that's part one of the question. Part two says, if the company pays $500 to deliver the goods to its three retail outlets, how would the $500 delivery amount be expensed? The delivery amount that they incur to send that to their customers would be basically an expense. So that $500 would just be recorded as a delivery expense. So debit delivery expense, credit cash. So that's how we would deal with 5-3. Now let's move on to 5-4. So in starter 5-4, what we're looking at doing here is starting to do some journal entries. Now, part A of the question is prepare journal entries for the following transactions, focusing once again on a perpetual inventory system. Purchases of inventory during 2020. So if we look at A and we look at part one, if we're buying inventory, once again, inventory is an asset. So we're going to debit the asset account because we're going to increase it for $450,000. And the inventory was purchased on credit. That indicates that in the question. And so that means we're going to set up a liability, our accounts payable, for $450,000. Fairly straightforward. Let's go to part two of A, sales during 2020. Now, the sales totaled $800,000 and 75% were on credit. So we know that of the sales, we collected some in cash. We collected 25% of the total sales in cash. 75% were on credit. That would be our accounts receivable. And then we would credit our sales revenue for the full amount. So our sales revenue is $800,000. If we take 25% of that, our cash that we collected was $200,000, and our accounts receivable would be $600,000. So that again is the journal entry for part two of A. Then we go to part three. Now, whenever we have a perpetual inventory system, whenever we make a sale of our inventory, we always need two journal entries. One to record the sales revenue, which we just did, and the second one is to record the cost of goods sold. Now, cost of goods sold during 2020, it says that 65% of our sales revenue represent our cost of goods sold. So then all we need to do then is cost of goods sold is an expense. Whenever we record an expense, we record it with a debit. So 65% of 800,000, that's going to be 520,000. And the credit is going to go to our inventory account because our inventory is now going to be reduced because we've sold that amount. So those are the three journal entries for part A. Then we're going to go to part B. Part B says compute the balance in the inventory account at December 31st, 2020. That's at the end of the year. So the easiest way to demonstrate this, part B, is just set up a T account. So let's set up our inventory T account. We know that at the beginning of the year, our inventory has a balance of $190,300. Now, all we're going to do is just follow that cost of goods sold equation. Beginning inventory plus all of our purchases. Our purchases were $450,000, and that's going to give us our goods available for sale, $640,300. So this is our goods available for sale. Beginning inventory plus purchases, that's the total inventory we have available for sale. Now, what we're trying to figure out then is, what is our ending inventory at December 31st? Well, all we need to do now is put in our cost of goods sold. Remember our cost of goods sold? We're going to debit cost of goods sold and credit inventory. And so that credit is $520,000 That's the value of the inventory that we sold. So that's going to leave an ending inventory balance of 120,300. That's the answer to part B. So those are some basic journal entries with respect to inventory purchases and sales. So let's go back to our handout and let's look at the next topic. So the next topic we're going to look at is recording sales of inventory. Now, we just did a couple examples where we debited the cash or accounts receivable and the credit was to sales revenue. And then we also have to debit cost of goods sold and credit inventory. So once again, whenever there's a sale of inventory, we need two journal entries. One to record the sales revenue. So one to record the sales revenue, and another journal entry to record the cost of goods sold. Now, one thing I want to talk about is these new contra accounts. Let's say you make a sale to a customer and then they decide to return that amount. Or let's say you make a sale to a customer, they get the inventory item home, they realize it's slightly damaged, and so they want you to give them an allowance. So that there could be sales returns, there could be sales allowance. And sometimes when we make a sale on credit, in order to encourage the customer to pay us sooner, we may give them a sales discount. So now we're going to come into some contra accounts. Sales discounts, returns, and allowances. We're going to see two new accounts, sales discounts and sales returns and allowances. These are contra accounts to sales revenue. Now, we talked about contra companion accounts. They basically are connected to the main account. In this example, the main account is sales revenue, and they're always recorded with the opposite sign. So sales revenue recorded with the credit, sales discount, sales returns and allowances recorded with a debit. So let's have a look at Starter 5-9. So look to page 287 in your textbook and pause the video, read through Starter 5-9, and then we'll work through it together. So pause the video here to read the question first. So let's have a look at Starter 5-9. Now in Starter 5-9, we are going to be making some sales of revenue. So let's look at what happens on August the 1st. August the 1st, the company sells $160,000 of sportswear using the credit terms 210 net 30. So let's actually talk about this credit terms 210 net 30. Whenever a sale of credit is made, in order to encourage the customer to pay sooner, this is saying that we're going to give them a 2% discount if they pay within 10 days. So if they pay within 10 days, we're going to give them a 2% discount. Otherwise, the net amount is due within 30 days. So 2% discount if the amount is paid within 10 days. Otherwise, the net amount is due within 30 days. Now, that's the example used in this question. You could also see things such as 115 net 45. All this would say is that you get a 1% discount if you pay the balance in 15 days. Otherwise, the net amount is due in 45 days. So there's different ways of expressing the credit terms. It could be a variation to what we have in this question. Now, in this question, again, we have these credit terms 210 net 30. So let's focus on that one for Starter 5-9. Now, we're going to record the journal entries. So on August the 1st, let's record the journal entry. Now, whenever we have a sale of inventory and we're using the Perpetual inventory system, we need two journal entries, one to record the sales revenue, one to record the cost of goods sold. So let's record the sales revenue first. This is all on credit because we have these credit terms. So debit accounts receivable, 160,000, credit to sales revenue, 160,000. So that's the first journal entry. The second journal entry is our cost of goods sold. So our second journal entry, we're going to debit our new expense called cost of goods sold. That's going to be 76,000, and then the credit goes to inventory. So once again, fairly straightforward. That's similar to the journal entries we did in the previous examples. Now, the challenge comes is that the company is going to pay us on August the 10th. And this is within the credit period, the 2% discount credit period. They're paying within 10 days, so we're going to give them a discount of 2%. Now, let's just figure out then what is going to be our journal entry on August the 10th when we receive the cash. Now, I'm just going to draw some T accounts. We know that our accounts receivable is $160,000. We also know that our sales revenue is $160,000. So those are the two T accounts for our accounts receivable and our sales revenue. Now, if we think about this, if our sales revenue is $160,000 and we give them a 2% discount, the amount of that discount is going to be $3,200. So let's actually think about this. The cash we're going to collect is going to be 98% of $160,000. Remember, we're giving them a 2% discount. So the cash that we're going to collect, our debit to cash, is going to be $156,800. Now, what happens to our accounts receivable after we receive the payment from our customer? Will our customer still owe us any amounts? Should there be a balance in accounts receivable? Well, the answer would be no. After our customer pays us, even though they're paying us less than the 160, this amount should go to zero because they don't owe us any more money. So we know that part of this journal entry is going to require a credit to accounts receivable of 160. So we look at this journal entry, then the question is, what are we missing? Well, every journal entry, total debits must equal total credits. So we're missing 3,200 in debits. This is the amount that's going to reduce our sales revenue, but we're not going to record it in our sales revenue account. We're going to use a contra account called sales discount. And that sales discounts is going to be a contra account to sales revenue. If you think about it, let's move back to our T accounts. Our sales revenue is $160,000. But in actual fact, what should our sales revenue be? Our sales revenue should be $156,800 because that's actually what we collected from the customer. So we have this contra account called sales discount. And remember we said with contra accounts or companion accounts, they always have the opposite sign. So sales revenue has a credit amount. Sales discount will have a debit amount. But because these two accounts are connected, what we'll show on our income statement is we'll show our sales revenue less our sales discount. So on our income statement now, we're going to have sales revenue of $160,000, and then we'll less our sales discount. And remember we said we might have sales returns and allowances as well. Let's just put that down here. In this example, that amount is 0, but our sales discount is 3,200, and so our net sales revenue on our income statement, that's going to equal, once again, the cash that we received of $156,800. So our sales revenue is going to be $156,800. That's going to be the amount that shows up on our income statement. So that's an example of how we have these new contra accounts to our sales revenue. So let's go back to our handout and let's look at the next part of our handout. The next part of our handout, just some minor items. If we think about inventory, Inventory that's not sold is going to be on our balance sheet at the end of the year as an asset. Any inventory that is sold is going to show up on our income statement as our cost of goods sold, our expense. Now, the textbook also talks about adjusting inventory based on a physical count. Usually what happens is at the end of the year, or maybe at the end of the quarter, depending on the company's policy, they're going to do an actual inventory count. And the actual inventory count might have a different amount than what's showing up in the inventory accounting records. And that could be maybe due to theft or could be due to error. And so all this is saying is that if your actual inventory count shows a lower amount than what's currently on your accounting records, the true amount is your inventory count because you actually physically went around and counted all your inventory. So that's the true amount. What you have to do then is to bring your inventory down to the right amount. And so your journal entry is going to be debit cost of goods sold, credit inventory, to bring the actual inventory accounting records to the actual correct amount based on the inventory count. Now, the textbook also talks about some closing entries for a merchandise company, and you can just sort of read through those on your own, page 258 to 59. Now, the next thing the textbook talks about is a multi-step or multiple step income statement, and there's an example on page 260 in your textbook. Now, on the next page of your handout, here's an example of a multi-step income statement. Now, you're still going to be calculating net income. So it's still going to be all your revenue minus all your expenses. The only difference is that we have some new subtotals. We have our net sales revenue. Remember we said that on our income statement, we're going to have our sales revenue less our discounts and returns and allowances. That's going to give us our net sales revenue. Then we're going to have our gross margin. Net sales revenue minus cost of goods sold is our gross margin. The reason that we have these subtotals is that it gives the user a financial statement more information. We know that this company had total sales of $120,000. They offered discounts to their customers, and the discounts totaled $2,000. And they also had some returns and allowances, maybe because the product was inferior or slightly damaged, and that amounted to $8,000. So this gives us an idea of how effective the discounts are. Did the customers take a lot of discounts or did they not? Was there good quality inventory that was sold? Was there a lot of returns and allowances? So that's the reason why we set up these contra accounts for discounts, returns, and allowances, to give additional information about this company. And then we subtract their cost of goods sold and we get gross margin of $70,000. So this $70,000 gross margin or gross profit says, based on just the cost of the inventory, based on what the company sold and based on the cost of the inventory, the company generated gross profit or gross margin of $70,000. That's how much money they actually made just from the sale of their inventory. And then we subtract what we call operating expenses. These are all the expenses that the company incurs in their day-to-day operations. And that then gives us a new subtotal called operating income. Now, this subtotal is important because this tells us, did the company make any money? Did they make any profit or net income based on just their day-to-day operations? And so in this example, they did. This company made $8,000 of operating income just based on their day-to-day operations. And then after that, we add these other amounts. These are other revenue and expense amounts, but these are separate from their day-to-day operations. And once again, the reason that this operating income amount is important is because that's why the company is in business. We want to figure out what is the income based on the reason that they're in business, their day-to-day operations. These other amounts are revenue and expense amounts that we include in the income statement, but they're outside their day-to-day operations. And so then we get our net income at the bottom here. So once again, it looks similar to the income statement we've seen in the past. The only difference is we have more detail. We have our net sales revenue, we have our gross margin, then we have our operating income, and then finally our overall net income. Couple remaining topics in this chapter. Now we're going to get into some ratio analysis. The first one is called the gross margin or gross profit percentage. All we do is take our gross margin or gross profit divided by our net sales revenue. And once again, we just got those amounts from our multi-step income statement. We have our gross margin and we have our net sales revenue. But let's go back to our example here. Let's say that you went to the bookstore and you bought a textbook for $100. And let's say the bookstore cost of the textbook was $70. Their gross margin would be $30, or we can express that as a percentage. The gross margin divided by the sales revenue is gross margin percentage of 30%. Now, obviously, when it comes to ratio analysis, we have to distinguish whether a higher or lower amount is better. A higher gross margin percentage or gross profit percentage is better. We want to be earning more gross margin for every dollar of sales revenue. Then we get into a ratio called inventory turnover. Cost of goods sold from our income statement divided by average inventory. Now, when we talk about average inventory here, all we're going to do is take our beginning inventory, our inventory at the beginning on our balance sheet, plus our ending inventory on our balance sheet. We're going to add those two together, and then we'll divide it by 2. So average inventory, beginning inventory, what we have at the beginning of the year on our balance sheet, plus what we have at the end of the year on our balance sheet, divided by 2. Now, let's say that company A has an inventory turnover of 8 and company B has an inventory turnover of 12. Now, 8 basically means that company A is selling their average level of inventory 8 times a year. Company B has an inventory turnover of 12. They're selling their average level of inventory 12 times a year, about once a month, right? Every month they're selling their average level of inventory. Now, inventory turnover, a higher inventory turnover is also better. We want to be turning our inventory over. We want to be selling our inventory more times a year. That way, we're not going to have any old or dated inventory. It keeps the inventory newer. And once again, we're just keeping our inventory turned over and sold more times a year. That is just better overall for efficiency. So what I want to do is take a look at Starter 5-16. So turn to page 288. Have a look at 5-16. See if you can figure out what is the gross margin percentage and what is the inventory turnover. So pause the video here and then complete Starter 5-16. And then once you've done the solution, you're on your own, then resume the video. So let's have a look at 5-16. Now, in this question, we're asked to first calculate the gross margin percentage. So when it comes to the gross margin or gross profit percentage, we know that we take our gross margin divided by our net sales revenue. And gross margin is sales minus cost of goods sold. So in this example, we're actually not told what our gross margin is, but we can figure that out by just taking our sales minus our cost of goods sold. So our sales is 66 minus 35 divided by our sales, which is 66. And so that's going to give us 31 over 66. And with the gross margin percentage, it should be expressed as a percentage. If you work it out, you would get 0.47. And so that would equal 47.0%. So all we're saying here is that for another way of thinking about this is for every dollar of sales revenue, we're generating 47 cents of gross margin. So what you could say is you're generating 47 cents for every $1 of sales. generating 47 cents of gross margin. So we're generating 47 cents of gross margin for every dollar of sales. So obviously a higher gross margin percentage is better. Now with the last one, we're looking at inventory turnover. And once again, inventory turnover is basically our cost of goods sold divided by our average inventory. Now, we know that our cost of goods sold in the question is 35. And then we have to figure out, well, what is our average inventory? Now, in the question, we're given the inventory at the beginning of the year and also the inventory at the end of the year. Now, the beginning of the year inventory is also equal to last year's ending inventory. So last year's ending inventory was 13.2. This year's ending inventory is 14. And that's going to give us our average inventory. So this is going to give us 35 over 13.6. And once again, if you work this out, 2.57 times. Now the question says to round this to one decimal place. So if you were at, say, answering this on my accounting lab and it says to round it to one decimal place, you would have 2.6 times. That would just be rounding to one decimal place. So all we're saying is that the average level of inventory is being sold 2.6 times per year. Now, once again, we did say higher is better, but it also really depends on the type of business that you're looking at. If you're looking at a car dealership, they're probably going to have a lower inventory turnover than, let's say, a grocery store. A grocery store, because they have perishable products that will spoil, their inventory turnover is going to be a lot higher. A car sales will probably have lower inventory turnover because they're not going to sell that many cars during the month. They're going to have a slower inventory turnover ratio. So once again, when we're looking at inventory turnover, higher is better, but it really sort of depends on the industry that you're talking about and what that inventory turnover level might be. So to wrap things up, if you look at the bottom of your Chapter 5 handout, I've indicated here that this is a really good exercise to do on your own. I have posted that solution on Brightspace D2L. So work through exercise 5-27 on your own and also go through any additional questions that you may find helpful. The textbook has some good examples and also a good summary problem. And I also have posted other solutions from Chapter 5 on D2L Brightspace, so work through those on your own as well. So that brings us to the end of this Chapter 5 tutorial, and we'll see you in the next video tutorial.